Hi, Prof Navarro here with some instructions on what should be a really interesting StockTrak macroeconomic challenge contest. Let's start with the big picture. The StockTrak assignment works synergistically with the forecasting methodology that you learn in the Always a Winner book and apply in the SoundView capstone exercise using data, graphs, and other information from the Dismal Science website. The purpose of the StockTrak piece of this synergistic puzzle is to help you better understand the complex relationships between bond, stock, and currency prices. The broader goal is to help you be a better economic forecaster, as the bond, stock, and currency markets are all important leading indicators of the economy. For example, a strong bullish trend in the stock market is generally a signal of an expanding economy, while a bull market in bonds usually indicates a weak or recessionary economy. And please know this, as a rule, stock and bond prices move in opposite directions, which is why the corporate finance models of stock market investment use asset allocation between stocks and bonds as a natural hedge against business cycle risk. Got that? If not, rewind me and listen again. As for the currency markets, this is a far more subtle world you will enter into. The goal here is to help you tune into monetary policy as it is practiced by central banks around the world, and also to help you see how changes in monetary policies across countries affect relative exchange rates. For example, if you see a weakening euro, it may mean that investors are expecting the European Central Bank to lower interest rates in response to a weakening economy. That is very important information for anyone trying to forecast the economy, and it is equally important information for a corporation importing from or exporting to Europe. In a similar fashion, a stronger dollar may mean interest rate tightening by the Federal Reserve in response to more rapid economic growth and the inflation that comes with it. Or maybe turn this around. Suppose you're managing money for a large hedge fund and you work on the currency desk. If you think the Fed is going to tighten, you will be loading up on currency futures that bet on a rising dollar. So the big idea here really is that you have exchange-traded funds and you trade them in a way which teaches you the relationships between stock, bond, and currency prices, as well as how these prices react daily to the flow of macroeconomic news. Now, what about the actual contest? Well, here are the rules. StockTrak gives you $1 million of play money to invest over the contest period under very strict conditions designed to help you hone your macro skills. Basically, you have 4 self-contained boxes that you must trade within. For example, in box 1, 25% of your initial funds must be deployed either on the short or the long side of the U.S. stock market. If you are forecasting an economic recovery or continued expansion for the U.S. economy, you will be bullish and you will want to be long. Therefore, you will buy the ultra-long exchange-traded fund with the symbol SSO. On the other hand, if your economic forecast for the U.S. is for a recession or continued slowdown, you will be bearish on the U.S. stock market. In this case, you will want to go short. Therefore, you will buy the exchange-traded fund SDS. This is a double short of the U.S. stock market. STS will go up if the market goes down. And by the way, we use ultra longs and ultra shorts in some parts of this contest simply to accentuate your gains or your pain. Now, let's go to box 2. In this box, you will be trading the Chinese stock market. And the teaching point here is that a strong Chinese economy will distribute benefits to many of the commodity nations like Australia, Brazil, and Canada that sell the resources China needs to run its factory floor. By following the Chinese stock market, you not only keep your eye on the world's largest economy, you also keep your thumb on the pulse of the commodity nations. As for how you trade the China box, 25% of your initial funds must be deployed either on the long side of the Chinese market using the exchange traded fund FXI or on the short side using FXP. Note that as in all the boxes, you can't go half and half in each of these two instruments and thereby create a hedge. Instead, you have to fully commit one way or the other. As for box 3, you must deploy 25% of your initial funds on the short or the long side of the long bond market. If you're bullish on the economy, you will likely want to short the bond market. This means you will go long the exchange traded fund TBT. This is an ultra short of the long bond with 20 plus years of maturity. On the other hand, if you think the economy will be soft or is heading into a recession, you will likely want to go long the long bond. In this case, you will put all your box 3 funds into TLT. Finally, in box 4, you will be allowed to trade a fairly large basket of currencies, but only on the long side. The idea here is to teach you about relative exchange rates. For example, if you are anticipating a stronger dollar, chances are that is going to also mean a weaker euro. That's because currency values are relative values, describing how one currency trades for another. This chart shows you the available currency instruments you can buy in the contest. These include UUP for the US dollar, FXE for the euro, BZF for the Brazilian real, and so on. Thus, for example, if you see a boom in commodities, you will want to buy a currency like the Aussie dollar or the Canadian dollar, as both Australia and Canada sell a lot of commodities. By the same token, if you think India's new prime minister is going to turn around the country, you may want to be long the Indian rupee. Unless, of course, you think the prime minister is going to engineer an export-led recovery by slashing interest rates and driving the value of the rupee down to do so. Do you see how complex this kind of trading can be? Well, that is the point of this contest, isn't it? To tune you into the macro world. The idea is to sensitize you to central bank monetary policies around the world and how they relate to economic conditions in the host countries. Okay, those are the rules. Let's talk about your best trading strategy. Here's the way you should approach this exercise in 3 basic steps. In step 1, you first want to develop your forecast of the U.S. and global economies using the Always a Winner forecasting model and the relevant data from the Dismal Science website. In step 2, you deploy your cash in a manner consistent with your forecast. For example, if you are bullish on America and China, you will likely want to go long the U.S. and Chinese stock markets and short the long bond. You probably want to be long the U.S. dollar as well, as strong economic growth in the U.S. is likely to drive up interest rates, which act as a magnet for more foreign investment and thereby drive up the dollar. And by the way, I don't include the Chinese currency in the contest simply because it's pegged to the U.S. dollar. Now here's the punchline and the really important point of this contest. If you're losing money in the contest, it probably means your forecast is wrong. And if your forecast is wrong, you're probably going to apply the wrong strategies and tactics at your organization, or make the wrong trading and investment decisions if you are a money manager. So the really big picture here is that this contest provides you with a really nice feedback loop on your efforts to forecast. If you learn how to make a few bucks trading stocks, bonds, and currencies as part of the exercise, well, that'll be a bonus for your 401k and retirement plans. As a final comment on the exercise, try not to panic and start trading willy-nilly if you start to lose a bunch of money. Instead, stop and assess. Try to figure out what you missed in reading the macro tea leaves. Above all, have fun with this contest. It's only play money. So good luck, and we'll see you soon. I'm Prof Navarro from the University of California, Irvine.